everybody out there. Welcome to the Utah REIA. I'm super excited here tonight. We got Jason Williams. He's going to be going over underwriting and the things you should and should not look out for. You should be looking out for as you're underwriting commercial properties. I think we're going to be concentrating a little bit on multifamily, but I know Jason underwrites all different types of assets. He's been doing it for a while. So again, super excited for this event. I would say if you guys are tuning in, we got a few people already tuned in. You guys have questions, again, targeted around underwriting. And I know Jason well enough. He can definitely help navigate. If you're getting into the commercial landscape and you want to understand, I mean, numbers at the end of the day, especially when you're in commercial, it's a business, and you definitely have to understand numbers, how to understand proformas and what you're looking at. But even if you're coming from the aspect of maybe more of a passive investor, and you want to be able to look at it passive, but you still want to be able to understand and vet out the financials, we can sort of, again, I know Jason well enough, he can kind of come from both angles. But again, super excited. Thank you guys for joining us tonight. And without further ado, I'm going to turn it over to Jason. Jason, maybe just introduce yourself, who you are, and why underwriting, and what got you kind of into it.
Yeah. So thank you for having me. You can see my screen, right? Because I can't see anything. That whole intro thing, it was
Yep.
like going in my background, and I had no idea how long it was going.
We can see the screen and you perfectly.
All right, cool. Thanks. So, who am I? I'm Jason Williams. I earned my PhD in chemical engineering, and I've had a 15 plus year long career as an R&D engineer. But I've been investing in real estate for over 20 years now. I switched to real estate full time in July of 2022. So that's almost 3 years now. I've been a full time real estate investor. And I've trained and worked with numerous high performers in the industry, such as Joe Fairless, who I believe has 2.7 billion with a B in assets under management, and Trevor McGregor, who is a Tony Robbins coach, or was, and now he's doing it on his own. So, and what I do as an engineer, my major theme was developing numerous systems to make, one, my job easier, and two, as an R&D engineer, I worked in a lab. I tested equipment, brand new equipment that our sales team had to sell. So I created systems so that our lab techs who didn't have the engineering degrees could go through the data quickly with a punch of a button, and we can get the sales people what they need so they can sell our equipment accurately and efficiently and quickly. And so I did a lot of that through Excel and writing my own macros. And so I brought that same idea into real estate investing, and specifically with multifamily and other commercial real estate underwriting. My current models I've been developing for over 7 years. I've gathered parts from almost every major guru out there. Their underwriting models. I've taken what I liked and I've improved upon them, and sort of throughout everything I didn't, fixed everything. And so my model is constantly evolving, with the strange times we're in now with weird interest rates. There's a lot of creative financing going on. Most models cannot handle that, but I can go in and fine tune all of that, just so that, one, we can still size things accurately and still be creative. And I've also created custom models for syndicators, different asset classes, RV parks, mobile home communities. I'm currently working on hotels, so that's what I'm currently still in my model development, and I'm also working on creating it to be a web-based version as well. So is this for you? Is my underwriting either, and I have a podcast, I have website, I have free information going out, and I recommend all either multifamily investors or commercial real estate investors who want to put deals together on the concrete of or on a foundation of concrete. I give you a lot of information for that. Or if you just want to keep your head in the sand and have a foundation of that same sand, then you can go and tune in somewhere else. So imagine what your portfolio would look like if you knew every time you sat down and ran the numbers, you knew right away if the deal was worth pursuing or not. Or you could submit LOIs with confidence. I know every time I submitted an LOI, I'm like nervous. I'm like wondering, did I get everything in order? All my T's crossed, my I's dotted. So when you do all, if you learn underwriting, whether it's from me or someone else, you can start submitting those LOIs with confidence. And then you have the confidence to share your numbers with investors and lenders. And because if you are putting a deal together and you're trying to raise money and you're looking for investors, they are going to ask you hard questions and you need to be able to answer them. Lenders, they're wanting to know a lot of the hard questions as well. And so you have to be able to answer those, and you can do that with confidence. And like I said, I've used lots of gurus models out there. But the funny thing is, a lot of those gurus do not even use their own models. Some of them do, most of them do not. They might have like a dumbed down version for their students or whatever. But when all the dollars are at stake and you want to ensure your investments are safe and sound and profitable as possible, then you need to get some sound underwriting education. So tonight, I'm going to go over the 7 red flags of underwriting, or if you want to call them the 7 deadly sins. These are what I've seen. I also do underwriting consulting for people, and all of these red flags are what I've personally seen when helping people with their underwriting. So,
Let me take a step back. Try to break it down. Just for so if we have a listener out there, and again, if you guys are out there and you guys have questions, just put it in the chat. But maybe break down at its full fundamental, because you spit out some words there that I would assume most people don't know. Like you talked about macros, and different aspects of it, but can you break down like what is underwriting in its basic form, and why is it important?
okay, so underwriting in its basic form is running the numbers to make sure an investment is going to be profitable or not, and if it's worth investing further or not. Um, so if you're going to buy a single family house, you're going to be running numbers like, all right, what's the purchase price? How much of a down payment do I need? What is roughly my cost every month for maintenance? What's the rent going to be? And so with a single family, you'll have maybe a few items you'll have to worry about. You can do some like rough estimates and ballparks for that. But whenever you get into commercial real estate, then you're taking on another business, especially if you have third party management, property managers who are going to be running the property for you. They're going to give you profit and loss statements that are probably hundreds of lines long of individual items. All right, you have payroll, you have taxes, you have insurance, you have make ready expenses, you have say paint, you have uh, pest control, trash, water, all of this stuff. All of this stuff, the more items you can have and it can account for, the more accurate your numbers are going to be. With big large commercial properties also, you generally have more income other than just your rent. You'll have like your application fees, your um let's see, credit check fees, you have pet rents, pet fees,
Parking.
parking, covered parking, laundry services. You'll have all sorts of things that you're not going to experience really if you are only investing in like single families. Um, so I mean, you can depending on how what your business plan is for single families, but generally you're going to have a whole lot more revenue generators for commercial property as well as expenses you have to account for. And as I mentioned before, the more you can account for, the more accurate you're going to be. And so with underwriting, all it is running the numbers. So when you have all these things you have to account for, that's when things start to look hairy. People start getting anxious when they look at a big old spreadsheet and they see a bunch of line items and they don't really know what all that stuff is. But somehow it affects the bottom line of whether or not this is a good investment. And so that's what I'm here to help with. And 90% of what I do is figure out how to make the most accurate numbers for you to move forward. So
Awesome. Thank you.
and you asked about macros. So with Excel, there's a lot of functionality in Excel, but there's also the ability to write your own programs that run in the back of Excel. And those are called macros. So I create my own macros so that it basically expands the functionality of the spreadsheet that I need. So,
Awesome.
all right. So ready to move forward?
Let's go.
All right. So the first red flag that I see all the time is trusting but not verifying. So a lot of times people will send me an OM and their underwriting, and the numbers they have in their underwriting are exactly the same as an OM. OM is your offering memorandum, it comes from a broker. They do some of their own numbers, and they put them in a nice package that they're trying to sell. The thing with brokers and sellers is once that property is sold, they don't really care how that property performs. So they are making it look as good as possible. They could be putting lipstick on a pig. So what I teach my students and I inform my clients is, all right, you can look at these numbers, but you need to verify with a third party what these numbers actually could be for your pro forma. Your pro forma is what you project your numbers to be going forward. Um, so like a broker and a seller, if you get numbers straight from the seller, that they have an interest in getting rid of this property. So I mean, you are the buyer or the purchaser. You are going to be in this long term, so you need to be able to trust your own numbers. And the funny thing is if you talk with a broker, they'll say like, hey, well, our underwriting says this should be this and this and this. And so they expect you to trust them. But then at the very fine print at the bottom of the OM, it says, don't trust any of these numbers. Do your own due diligence. These are just for, I guess, little representation of what this property could do. And so the brokers usually talk out of both sides of the mouth in that regard. So again, trust but verify. So you need to get third party verification on all the numbers you put in. So and a third party would be like a property manager or somebody who's be vested in that property after you buy it. So like the property management company you'll be using to run it. For taxes, it could be your tax advisor who you're going to be using to protest taxes. Insurance, you could use your insurance broker who you're going to be using for insurance. So there's going to be a lot of people who would be vested in the property who can give you accurate information in that regard. So the second red flag is using temporary trends for the long game. And I saw this more, uh, what, 3, 4 years ago when interest rates were way low. Like we're looking at 1, 2% for agency debt. And you had growth rates in the double digits. I think San Antonio a few years ago, they had like 30% plus rent growth. And I have seen people use 30% rent growth for year over year for like a 5 or 7 year hold. So I suggested they use something more reasonable, like a 3%. But if you know anything about like the San Antonio market or Phoenix market or any of those that were booming a few years ago, they actually had negative rent growth, especially whenever the interest rates were climbing. So they were actually lowering their rents just to maintain occupancy. And if you were projecting 30% rent growth and that you were actually seeing negative growth, you are going to find yourself in a world of hurt. Now, granted, you had to use 30% rent growth to be competitive so that you could get the property, but that property is, and anybody who used that and trying to be competitive would have lost. They're 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 behind. And I know there have been a lot of foreclosures on properties and since the last 3 years. And so that is like showing you, hey, maybe you're overpaying for this because you thought it would do better, but you can't even maintain your debt service, and so the bank ends up taking it. And I'm sure you've heard of many foreclosures as well, Chris, because I mean that's if they were really aggressive in that regard. So the third red flag
But
is
let me go back. Sorry, let me pause there. Kind of looking back at the well, actually, we're still. Oh, sorry, you went back. Okay, so on the this temporary trends, what would be the recommendation for? I mean, you threw out a 3%, which is what I commonly see in underwriting models, especially for multifamily. But say instead of using the arbitrary 3%, what would be a good metric to use? Just say, and let's just go rent growth because that is typically one of the more impactful factors when you're putting your underwriting or pro forma together. So, what kind of would you look at and what would you use?
so I would look at rent growth in this regard is very market specific. Um, if you're, I'd say I don't know, say the Salt Lake City market very well. I know people who invest there. I knew they do really well, but I don't know that market. If you brought me underwriting with like a 3 or 4% rent growth, I would I would assume that's probably pretty reasonable. If you brought me something like 10% or more, I would have said, well, you might need to double check this. Um, in my market, our manager tries to do about 4% per year. And so that's what I use in my underwriting in the markets where I invest. So this would be again one of the numbers you want to get from a third party, say a property manager who's been managing properties in that market, and they can understand how much they can increase rents before there's a lot of pushback from the residents. So I'm not going to give you a flat number to use. If you really want to be safe, 3% is generally safe. Um, Aside from the markets that were negative, but that again was a temporary trend, and I believe those are going back up for probably about 3 to 4% again.
Got it.
So
Yeah,
did that
that makes
answer
sense.
your question?
Yeah, I'll just I think I mean I would probably go back to what you said first. I mean, there is a lot of good information out there. There's third party software where you can get historic numbers. I like to look at for any duration. I mean, I pull historic duration, and because I invest, I know it's one of your red flags, but I invest in several markets. I don't just invest in one market because I like diversifying. All markets don't. They're all cyclically different. You go back to 2007 as an example, 2007, 2008, Austin was on fire the entire time. Now you go
Yeah.
back to just the last 2 years, Austin took a huge hit. So markets do not all react the same. The markets and the submarkets all act differently depending on what's going on. More from a larger economic standpoint, as well as like micro economics. They're all going to impact it. So, and there's a lot of good third parties out there. There's brokers that really understand the area. So if you're going to invest in different areas, and because I like to look at it from the passive side of it too, not just the active side, because I would assume we have different listeners. Um, I am more on the passive side. I do not want to pick up a 200 unit building and have to run and manage it. So I'm more on the passive side, trying to understand. Okay, I'm looking at it from the risk return profile, and I'm going to still underwrite it, but I'm going to ask questions exactly like you said. I'm going to go to a third party software, or I'm going to call up a broker and ask a broker what it would typically look like before I dump my hard earned money to it or take on the risk of taking on that asset. So I think what you said makes complete sense. I think too often times what I see though is people putting in that 3% number, which is I'm going to raise a flag because there's no ways every market is 3%. Some are going to be higher, some are going to be lower. It all kind of just depends. What I like to do as well is take that rent growth down to zero and then see what happens to the performa and see if it can still sustain on a zero rent growth. Obviously, you have times where it's negative, but it's normally short lived.
Yeah. So for the last, um, so my model, what I can do is I can change my rent growth for year over year, and I can go up to 10-year model, or I have a 10-year model, so I can go out for 10 years. A lot of the deals that I was looking at over the last couple years is I was putting in 0% rent growth for like the first 1 to 2 years, and then
Mm,
slowly increasing it
yeah,
so that I could see, all right, I can't adjust any rents right now. And I don't foresee being able to for the next 12 months. But after that, I want to start bumping it up till we can get something sustainable.
that's another
Because
good point too. Yeah, especially if
I
you're
mean,
looking at a performer right now, I
yeah.
would wholeheartedly agree with that.
Because I mean, everybody is here. We're investing to make money, and if your business plan is to not increase rents or anything, you're never going to make money. So you have to, and I know landlords get bad names, and it's like, "Well, you were increasing my rent," blah blah blah. It's like, yeah, well, insurance went up, taxes went up. We have to, because unless you want to live in the street, because the bank's going to take it, and I guarantee you, the bank is going to increase rents even higher, or get rid of it or whatever. So I mean, we have to try to make money somehow, and so you're wanting to see some rent growth. But if you just say, like, if like a lot of the models you put in 0%, that's going to be 0% for the entire lifespan, and that's not sustainable generally. So, and I
Well,
also wanted to point out that most of these red flags come from operators who are trying to buy properties themselves, and so they don't necessarily pertain to passive investments. But I will get into that a little bit later as well. So, go on. You were going to say something.
no, go ahead. I think we're good.
Okay. Let's see. So again, red flag number 3 is arbitrarily following a guru. There are gurus out there. There's also that are good. There's also gurus out there who are only selling you a platform or program, and they charge, say, $40,000. Or if you want only the 3-month package, it costs $20,000, and you work with a coach of a coach. You might not necessarily get the benefit that you think you're paying for. And so you need to do your research for finding a good quality guru. Me standing here or sitting here, I'm coming off as a guru. And so when I'm saying don't arbitrarily follow a guru, I include me as well. I want you to do your due diligence and find out who some of my clients are or some of my students, and figure out, hey, if I'm a good guru for you, then let's work together. If not, then go find somebody else. But there are, I know people who are in programs and they bring their underwriting to their weekly meeting. There's 50 people in that meeting and they're reviewing 4 deals in an hour. So that's roughly what, 15 minutes per deal. Plus you have like all the stuff before and after. So you're maybe getting 10 minutes on a deal. So what they're doing is they're going through and they have a checklist like, all right, you have this, 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 you have this. All right, this looks good. Submit your OI and call me when you need investors or whatever. And I'm just saying that I don't know if that's actually how it happens, but I do know that people have come to me after their coach has checked off their underwriting, and I have found many errors in their underwriting that should have been picked up previously. So, like I said, be careful who you put your trust and hard-earned money into, because not all of them are good. There are good ones out there. I have a guru. Joe Fairless is my mentor. So you need to find a mentor or a guru who's actually doing what they are teaching and not just having a coaching platform, and that's where they make all their money and they aren't investing themselves. So all right. So number four, red flag number four is blindly putting numbers into a model. So this sort of goes back to your the previous one where you're following the guru. You might have watched like a 30-minute, maybe an hour-long video on how to fill out a model. You might have gotten a model from somebody who at one time was a pristine model, but they keep changing it for different deals and they keep using the same model. It's like, all right, well, the last deal works, so let's just pull up that model and just start changing information in it because most of it's already filled out. But what happens is if you ever change like any of the cells in an Excel spreadsheet or something and you don't record it or you don't change it back, then you can end up killing those cells, turning off the equations so that they're not actually calculating what you think they're calculating. Or if you start adding in some more equations, then you might be calculating something you don't mean to be calculating later on. And what I have personally seen from one group is they were triple dipping their rent increase and it started on day one. So they wanted to say increase their rents $150 to bring it up to market. They didn't really have to do any renovations for anything, but somehow they put in 150 as the increase, but they also accounted for it on their own. So they put it in double, and I don't remember exactly how they triple dipped, but I remember it a triple dip that they added it in somewhere else and it was accounting for it. So on day one, they were going from say like 500 or 750 in rent, and they were wanting to go up to like 900, and they ended up going up to it was going to be is 450 total, so 1200 or whatever, and that was from day one. Right off the bat, you're not going to be getting that because you have leases you have to deal with. You can't change rent in the middle of a lease, and so those people were in for a rude awakening whenever they got their pro forma, and if they actually got it and they were running their business plan, they're like, well, why is our rent $450 lower than it's supposed to be? I thought we are increasing rent or whatever, but our numbers say this. And so you need to understand what numbers you put into a model and how they affect it. Now, if you come to me and you have me consult for you, I will go through your model. I go through every single cell, make sure the equations are doing what they're supposed to do. It's like a choose your own adventure where it's like, all right, this cell has this cell on, or this page tab cell plus this one on this one times this one. This tab cell. So I mean, I go through and I flip through everything to make sure that each equation is doing what it's supposed to do, so that I know that it's being calculated right. And that's how I found that they were actually triple dipping. I was going through, it's like, wait a minute, this one's calculating it here and here and here. And so they're thinking it's only doing this, but it's actually increasing it like threefold. And so it was a rude awakening for them, but I mean, it was a good exercise for me so I could see what that model was doing, and I pointed it out to them. So
Let me ask you a question. So someone comes to you, how much of an understanding of Excel, or I'm assuming you're building all this in Excel and not using Google Sheets, but how much understanding of Excel and Google Sheets do they need?
um I will teach you all your understanding. I mean, I sort of expect, like, you know how to do control C, control V, which is copy and paste. Just basic stuff. I don't expect you to be an expert in Excel. Um, I've had students who taught me some things on how to do it better. And if there's anything weird that I do, and there are some advanced functions that I do, I go through and show you how to do it step by step. So you don't have to be an expert, but you do have to have like some knowledge of Excel. So I I
Got it.
I don't consider it an Excel class, but we do use a lot of more advanced Excel functions. So
Got it. That makes sense.
anytime someone who didn't know or came in with less than basic Excel knowledge, I'd step them through it, like, and get them up to speed on the functions that we need for my model. So, all
Got it.
right. So, number 5 is considering only annual cash flow. And what this means is there's a lot of models out there that you'll look at it as a year 1, year 2, year 3, year 4, year 5, and that's all it is. But what happens if you have like a heavy value add play, and you know you're not even going to be up to market rent for say 6 months? Well, your annual cash flow for the year, say, might be $18,000. Okay. What it doesn't show you is for the first 6 months, you're negative 24,000. So you're coming out of pocket to cover your debt service, cover all your expenses. And this happens more often than not, especially for heavy value add. Until you bring those units up to a certain standard, you're not going to be able to get the rent increases you think you're going to be able to get. So you're negative 24,000 in the first 6 months. And then the latter half of the year is when you start making your money. And so you go so up to 42,000. Is that right? 24 plus 18, $42,000 in the latter half of the year, so that your annual cash flow is 18,000. If you're only looking at the annual cash flow, you're like 18,000, 12 months, that's 1,500 a month. That's not too bad. Um, but I've seen it numerous times when people didn't have enough reserves. And in my model, it has a big old red cell. It's flashing at you saying, hey, you're going to have to come up with additional cash after you close. So if you don't raise it, you are going to come out of your pocket, or you're dead before you even get started. Another way I've seen it is at a refi. When you do a refinance, you're usually at a higher property value, and so your debt service is then going to be higher, and so you might be at negative cash flow for like a month or two until you can catch up, and so you really have to watch that. So, and I haven't seen it break a deal, but I have seen people adjust their business plan or adjust the reserves they had to raise so that they could accommodate the negative cash flow months. So let's see. Then the next red flag is not stress testing. So everyone, like it says, writes underwrites conservatively, but what does that mean? Do you count for the worst case scenarios? Are you assuming your exit cap is going to be 2 points higher than what you come in at? Are you assuming it's going to be half a point higher? Or do you run different scenarios from half a point all the way up to 2 points higher? So you really need to, because nobody knows what's going to happen with the market 5 years from now. And you say, well, my market's pretty stable. I'm buying a 40-year-old property. It was built in the 80s, so it's pretty decent. But guess what? 5 years from now, that 40-year-old property is now going to be a 45-year-old property, and it's going to have 45-year-old property problems. So roofs, plumbing, and everything else. So all that stuff that's going to start increasing your exit cap because maybe you didn't have to replace a roof or you didn't have to replace any plumbing or drainage, but the next person will. And if they're budgeting for that, then that's going to start dropping their purchase price or me ultimately your sales price. And so you have to be able to account for that. And nobody has a crystal ball, but you need to at least be able to figure out, does this deal make sense if the exit cap is significantly higher than we expected? It doesn't even have to be exit cap that you're testing. Maybe you're testing, say, interest rates. What happens when interest rates go up and you have an adjustable rate mortgage and you don't have a rate cap, or the rate caps are too expensive and you're just going to ride it out? Can you ride it out? At what point will it start causing you to not be able to make your debt service? So all these things should be tested. Now, not all of them are going to apply to your property, but if you at least tested it, then you could at least mentally prepare for it and you can get a range of, say, returns for your investors. Say, all right, well, I can do this, I can do this. What the hold period is going to be. What if I hold it for 36 months or 48 months or 60 months or 62 months or whatever? How much is that going to affect everything? So all these things are going to affect your bottom line, and you really need to at least have an idea of what things are going to look like, whether they play out or not. So does that make sense?
Sorry, I was on mute. Sorry. What would be, so if I was looking at it, and I wanted, I mean, maybe come from, yeah, maybe look at again. Let me look at this from the standpoint from a passive. It doesn't matter. I guess it doesn't matter. What would
Mhm.
be the top three maybe sensitivity scenarios that you think every single invest? I mean, again, there's more than that, but let's just say what would be the top three that you would want every single person to give a sensitivity study on or sensitivity analysis?
So I always do exit cap. Um, that's probably one of the most arbitrary numbers out there that you have to have a crystal ball to figure it out, and nobody has one. So I mean, that's just the best guess. Another one is if you're doing a heavy value add play, what if it takes 3 months to stabilize your property, or 6 months, or 18 months? What are those numbers going to look like? Um, I'll even run different scenarios. All right, well, what's the purchase price going to look like? Or if we do it at this versus this, what's a purchase price going to look like if we include a refi? What if we refi at month 24 or 36, at 48 or whatever? So, I mean, there's all sorts of things to look at. And I reckon, and my model, You know how I was mentioning before that it's like a choose your own adventure a lot of times when you go to like sheet number 2, cell A3 times sheet 3, B59 or whatever. What I do in my model is I'll name sheet 2 A3 and I'll call it a name. You can do that in Excel. And sheet 3 B59 has a name so that in my cell it says, all right, we'll say NOI is purchase price. I actually call it purchase price or let's say cap rate. So purchase price, NOI divided by purchase price or whatever. I'll call them by their actual names so that I can then go in and change the scenarios. Like, all right, well, what if the purchase price is this, or what if the NOI is this? And so it can recalculate everything for you and do it like a side by side comparison of all of that. So, like every single variable can be changed in my model, and you can do it and run different scenarios for everything. For sensitivities, you can change exit cap rates, interest rates, um, stabilization period, refi month, and then you can have it like on a big old table that you can look at so that you can present that to your investors like, all right, so we're going to be somewhere in this table, we think, and 90% of this table looks good, and the other 10 is you're going to have to fork over another $10 million to make this property stay above water or whatever. So at least you know going in what it's going to look like for your business plan. So um ones I specifically look at, it really depends on the deal and everything. Growth rates, you can change your growth rate, whatever. Um, so you can change just about anything you want in my model that I like to look at. So
Got it.
um, and then number 7, and you this was you mentioned this earlier, not concentrating on a single market. This really pertains to active GP or active investors who are going to be running the asset and managing the asset. And the reason why you don't want to just like spread out, and I understand why you would want to as an LP, but as an active investor, you have to know every single thing about that market. You need to know, and it could be if you're like investing in DFW, it might be a handful of zip codes you are investing in. You need to know who the key players are, who all of the property managers are, who the good ones are, who are the ones to avoid. You need to know in my market, I know who owns the properties. Some of them I know personally, at least I have names of who the owners are um, for the properties. And you know, whenever you concentrate on a single market and you have multiple properties there already, then your comps, you already know what your comps are because you're your own comps. So you know, like, all right, our property down the street is getting this for a 2-2. So we can assume we're going to get this same for a 2-2 on this property type thing. Um, you have good relationships with vendors. You your property manager knows knows the market well. If you have a good property manager, they know who the property managers are of the other properties on like first name basis. They can call up people, say, hey, what are your rents for 2-2s? And there's like trading back and forth. I guess it's almost kind of like price fixing in a way, not necessarily, but if your market's small enough or tight knit enough, you can you can have a lot of information for it. And if you are spreading out, there's a lot of times that I meet new investors like, well, where are you wanting to invest? Like, I want to invest in Ohio. I want to invest in South Carolina and Texas and North Carolina or Georgia. I'll tell them, especially if they're students, I'll tell my students concentrate on a single market. Let's concentrate on a single MSA, and only look at that. And in my course, we go over a brief market analysis. Market analysis could be almost like its own 12-week course. So we don't do too much into that. But if you're trying to gather that much information and then you have 10 different markets you're trying to invest in, you're never going to be the expert out of it. So I recommend staying in a single market, knowing everything you can about it. And then once you have a good foundation and a good foothold there, and it's almost running itself, then you can expand your search to a different market. But um, on the LP side of things, I like to invest in operators more so than market. Um, so with my operators I invest in, I assume that those operators know everything about that market. So I like to invest in operators who only concentrate in single markets. Now I'm going to invest in different operators, so I might invest in Dallas and Cleveland and I don't know, Salt Lake City or whatever. Totally different markets, but each person that I'm investing in, those people only invest in those markets. So that's how I would do it as an LP. So this one doesn't really pertain, but if I was investing in an operator and they had markets of like South Carolina and Georgia and Dallas and Houston, I would want to know what their foothold is in each one and if they have like a solid footing or if they're just in those markets because that was the market du jour at the time they bought the market or bought the property. So does that make sense?
Yep, makes perfect sense. And I'm the same thing. I mean, I think you underwrite the you analyze and do diligence on the operator first. Know, like, and trust the operator that you're working with. Same as what you said. I diversify between different markets, between different operators.
All right. And now I actually have a bonus red flag. And my this one is make sure you have either coaching. If you're not going to do coaching, have a support system or you have a place you can go to get mentoring, free mentoring or education. um, I have a community. My wife and I have a community that's free, has lots of information. I have a lot of information on my YouTube channel and Instagram and LinkedIn. So there's a lot of free information out there. If you're looking to improve your underwriting or just improve your investing game in general, reach out to those communities. Real estate is not a single person game. It's a team sport, and the better team you have, the better you're gonna do. I know some people will think, no, you can't have a team. I want all the money for myself. So it's like, all right, I'd rather have 1% of 100 deals or rather than 100% of no deals or whatever. So um, real estate is a team sport. I mean, that's why everyone's here at REIA because they all know, hey, rising tide lifts all ships. So yeah, find a community and a coach or just a support structure so that you can go and get help when you need help. I'll tell you right now, when I underwrite a deal, I always send it to one of my partners to go through it, and he goes through it. He's not an underwriter, but he knows what to look for, and so when you're underwriting, you end up getting blinders on. You might be focused on one little detail, and like, all right, that one little detail is 100% accurate, and you're missing everything else. So even I don't do it alone, and I recommend everybody else going out and getting some help as well. So
Very, very good recommendation there.
So and that's it. So
I do not think we have any questions. Let me see. Give me a second. You must have done a superb job going through everything because there's no questions there. If you guys are out there, you guys have any questions, again, put it in the chat on whatever format you guys are viewing this on. Just put it in a chat. But let me take a step back. Well, not necessarily take a step back, but kind of maybe going back. So we talked about a whole lot. We talked just kind of the basis of underwriting. Let me kind of switch it up a bit. Um, how do you think AI is going to impact underwriting positively or negatively?
At first, um, I enjoy watching and playing chess, and I don't know if you've ever seen like Chat GPT versus Bard or whatever Google's AI is now.
No.
But if you ever get a chance, look at AI chess versus another AI chess, and I'm not talking about Stockfish or anything. I'm talking like Chat GPT versus whatever, and you'll see where AI is. It puts pieces on the board. You'll end up having like three kings, and a queen will materialize out of nowhere, and then it'll say, "All right, there's no more moves left, and you're only three moves in." So it's actually quite humorous. So that is my analogy to what I originally thought it would be like for underwriting. Is it's gonna like come up with random stuff, and you're gonna and if you trust it, you're gonna be in a world of hurt. But ultimately, what AI is a tool. It's not going to replace people. It might make things a little bit faster um, for you. It might tap into different resources to bring in more accurate information. But ultimately, it comes down to, and in the engineering world, we call it engineering judgment. And so it's going to come down to the underwriter who's doing it to make sure all those numbers are correct and verifiable. um I mentioned I am creating a web-based model, and I am going to utilize AI. um i'm I'm going to utilize it to make things a whole lot simpler. Currently, we're bringing it in so you can upload a T12 or a trailing 12-month profit and loss statement and a rent roll. And since there are so many different platforms out there on T12s and rent rolls, you really can't just hard code in um, something that will pull out all the information for you. So we're going to have to utilize AI in that regard so that it can, all right, so it might say, it might lump things into different categories or whatever. And when I'm really getting into the weeds on how we're going to use it, but um, like I said, it's a tool that can be utilized, but it's not going to replace the person who's required to do it. Computers are not going to be buying properties. At least I don't think they will be. People will be buying properties, and it's ultimately up to the person buying the property to verify all those numbers. So we might get to a point where computer might have like a big old bank account, and it's like, all right, it wants a bigger bank account, and it'll go out and buy a property. I don't know. I doubt it would be able to get a loan, but who knows? We got Skynet going on, buying apartments.
I wasn't going that deep, but yeah, just wanted to kind of get your take on it. Just super interesting. Um,
So
well, we are kind of at the top of the hour. I do not see any questions coming in, so again, thank you guys. How can actually I have your link, and I know that we're going to be partnering. The REIA is going to be partnering with Jason to be able to bring you guys more of these opportunities, more of this education. So kind of be on the lookout for that. We are just for those of you who are on for future. We're on the process of as well as relaunching our entire website and our onto a brand new platform to kind of make it more easy, user friendly, and streamlined, and be able to get access to education that we for people that we know trust. I mean, our goal at the RIA is to bring you guys all of the tools that you guys need necessary to succeed. And we feel strongly that Jason's one of those tools. and then he'll use AI as a tool to help improve his tools to give to you. So just be full circle. Jason, if they wanted to kind of get I'll put a link up as well here, but if they wanted to get to talk with you or know more about who you are, how can they get a hold of you?
Yes, so you can find me on LinkedIn, Jason Williams, PhD. You can go to my my website, ironcladunderwriting.com. I have a free masterclass there, and I have a lot of other free information. I have a 2-minute deal analyzer that you can go in. You can punch in some quick numbers just to make sure it's even worth pursuing even further. I have a community with my wife, as I mentioned before. Everything is accessible from the ironcladunderwriting.com. So that probably be the best way to get a hold of me. And if you don't remember that, you can always get a hold of me through Chris, because he'll be happy to make the introduction. So
Absolutely. Well, again, thanks, Jason, for giving us an hour of your time, kind of educating us on the nuances, the do's and don'ts of underwriting. Hopefully, everybody out there listening got some good value from it. And we will see you in the near future. Again, Jason, thank you very much for your time.
yeah, thank you for having me.
All right. Bye, guys.
Bye.